Welcome to the Cliffwater Direct Lending Index quarterly webinar for 1Q24. My name is Fran Byers. I'm head of capital markets at Cliffwater, and I'm joined today by Steve Nesbitt, CEO and CIO at Cliffwater and creator of the Cliffwater Direct Lending Index. Cliffwater is an alternative investment advisor. We're founded in 2004, and we are active across the alternatives investment spectrum. We currently advise on or manage over $107 billion in alternative assets. Steve is going to kick things off and run through the biggest takeaways from our 1Q24 index results, and I will follow with a recap of the big market trends that we're seeing in the direct lending market in 2Q24 and beyond. And with that, Steve, please take us away.
Thanks, Fran. On our first slide, we show performance for the CDLI for different time periods, all ending March 31, 2024. If you look at the bottom in the table, in the bottom row, it shows CDLI total return over these different time periods. It's been really more of the same over the last few quarters, where the CDLI, or middle market direct lending, has basically returned its current yield. So for the first quarter 2024, total return of 3.02%. For the trailing 4 quarters or year, 12.49%. 5 years, 10 years, high single digit, as well as from inception, which is almost a 20-year period at 9.50%. Focusing on the components in the table, the first row, interest income, really the driver of performance, with rates of return that are just a little bit above the total return of the index, lowered principally over time by realized losses. So let's focus on realized losses, the major detractor to performance. For the quarter, first quarter 2024, minus 23 basis points. That annualizes to about 80-some basis points. For the trailing 4 quarters, minus 85 basis points. Long-term loss rate has been about 1% going back to 2004. So basically, bottom line, the CDLI index earns its yield minus, on average, 1% for realized losses. There are markups and markdowns along the way. Those are unrealized losses, gains or losses. I'll talk more about this, but we've had some unrealized gains in recent years and recent quarters, primarily as reversal of unrealized losses in prior quarters. Generally, these unrealized gains and losses on markups and markdowns average to zero over longer periods of time. The total return quarter by quarter is shown in the graph at the bottom of this slide. You can see pretty steady positive returns quarter by quarter between 2% and 3% over most of the quarters, and hit road bumps along the way. But the financial crisis in 2008 and 2009 producing small negative returns. In 2011, that was the Euro crisis, if you recall. The energy crisis in 2015, COVID, almost minus 5% in 2020. This return pattern, many of you might identify not as a normal distribution, but one that's asymmetric, typical of credit instruments, continued strong returns quarter to quarter with periodic negative returns. The great thing about private debt and the index has been the positive returns are more frequent and more than cover the negative experiences, the fewer incidents when they occur. Just on this next slide, we show income. So again, I'm going to focus not on total return now, but on its components. And if we look at CDLI interest income, notice it's it varies, but it really focuses between 9 and 12%. Currently, interest income is at a high point relative to its history, largely attributable to a high reference rate, which most often is SOFR. We show that yield compared to T-bills. Okay, that's in the dashed line at the bottom of this graph. And so, if you look at the difference between the bars and the line, it basically shows the excess yield to direct lending. That excess yield has averaged 9.45% over this almost 20-year period of time. Switching now to both realized and unrealized gains and losses over this cumulative period. I'm showing rolling, in this case, rolling 4-quarter values. I'd like to first focus on the red line. The red line shows realized losses over this period for the CDLI. Notice just variation, okay? Realized losses from defaults are periodic over time. They're not constant, but they're relatively low. Yeah, over this period, they range between 0 and -5%, but generally the variation is between 0 and 3%. The higher loss rates correspond to the stress periods I talked about before: financial crisis, oil crisis, COVID, Russia, which the Russia crisis really coincides with the Fed's increase in interest rates as well. But the point I want to make is the unrealized gains and losses in green basically anticipate subsequent realized losses. And this goes back to the point of valuation I've always made, that but before there are defaults, or there are expectations of future defaults caused by these crises, those are captured in markdowns. Okay, so before the financial crisis, there were markdowns in these loans. Okay, and then those unrealized losses are reversed by either realized losses or a reversal in the unrealized losses through realized gains. And the point I've made before on valuation is that valuation, at least within the industry, does a pretty good job of, one, anticipating realized losses, and is actually fairly conservative in that the unrealized losses generally exceed the subsequent realized losses. So the trough of the green bars generally fall below their subsequent red line of realized losses. So the takeaway being, we have really pretty high confidence in the credibility of valuation with respect to direct lending. And this is particularly true for very diversified portfolios like the index. And just point out on the far right-hand side, so this is so also true for our current experience, where there were unrealized losses related to the Russia invasion, uptick in interest rates, creating unrealized losses just post the Russia invasion, and then that anticipated subsequent realized losses that we've been reporting the last few quarters, but at the same time, the markdowns exceeded realized losses. So we've had some unrealized gains, which we're also seeing in the performance numbers. So my point being, this is the valuation, realized losses, financial crises. This seems to be all very predictable as revealed by our index. And then before turning it over to Fran, again, what is our forecast? I picked a 3-year horizon because this is basically the effective maturity of private middle market loans. And far right-hand side, expected return for a typical private fund that's 100% levered, which on average, most our forecast net of fee is 10.5%. So let me illustrate how we get there. Current T-bills are 4.5%. SOFR is about at the T-bill rate. The net spread, including OID, original issue discount, is 6%. So unlevered, we take 4.5 plus 6. We'll bake in losses of 1%. If you pick good managers, you could probably do much better than that. But bake in 1% loss. Fees and expensive management fee and incentive fee 1.6% plus administrative fees. With the leverage, the spread from levered assets is 3%. That would be the 6% minus the cost of financing. That gives you 3% minus fees and expenses related to those levered assets. 45 basis points provides a net return of 10.5%. So basically, let me summarize before turning it over to Fran. I consider this a pretty quiet period for direct lending for private debt. Basically, spread levels have been at or maybe slightly above historical rates. Losses at or close to historical losses. I'd say the only exception is reference rates have been high, which have probably boosted returns at the 12 level as opposed to a more 10% level that I would expect to be the more normal level. So with that, let me turn it over to Fran to give a more short-term current market environment outlook.
Great. Thank you, Steve. So the market recap for direct lending in the second quarter is not going to be too dissimilar from what we had discussed on our previous webinar in April. A lot of the same themes are apparent, including strong inflows into the asset class due to the double-digit yield profile, and now the higher for longer rate expectation. And while the stock market's incredible 2024 rally that we've seen would signal to investors that everyone's feeling really good about the economy, these record inflows and strong sentiment that's coming into this loan market has not yet been met with sufficient deal flow. Although we do still maintain that the expectation is in the second half of the year, we believe we'll see a noticeable pickup in deal making given sponsors' deep desire to transact. But first, let's start talking a little bit about the overall picture in the liquid loan markets and how that's translating into direct lending. So the repricing wave that began the very first day and the very first month of 2024 has only continued to soar throughout the second quarter in the institutional loan market. We ended the first quarter of 2024 with 26% of the loan market trading above par. That figure has only risen. Now nearly half of the loan market has an average bid above par through the end of May. This has kept this massive repricing wave that started in January continuing for 5 straight months, totaling over $215 billion of repricings year to date and counting, which is highlighted in this gray bar here on the left. Meanwhile, new money lending in the institutional loan market continues to remain at quite depressed levels. But we are starting to see some momentum pick up. New money lending's back to that 20%, 25% of volume versus only being roughly 10% since the start of the year. So we are starting to see some nice pickup in supply, but it's taking a little bit longer than folks had expected. Flipping to the next slide, we can see how these big themes of repricings is impacting the direct lending market. So on the left-hand side of the chart here, we show you the mix of direct lending deals broken out between new money, M&A deal making, div recaps, repricings. And what you'll see is that right now, about 40% of direct lending issuance is M&A. That's about half of the levels that we saw at the same quarter last year. And repricings and refinancings are still at very elevated levels. In fact, they're driving the bulk of activity in the direct lending market. Now, historically, most sponsors used to refinance when they sold a business. And direct lending in any given quarter is typically 70 to 80% new money issuance. However, this buyer-seller disconnect on valuation continues to be an impediment on new buyout deals. So if you're looking to the chart in the middle, what we can see is that LBO deals that are getting done in the last year and a half have exhibited much lower EV multiples versus the deals that were getting done in 2021 and 2022, with base rates most likely being the culprit, since economic health has been pretty solid to date. Deals that are transacting this year have been residing much more in that 10 to 12 times EV range versus the hefty 15 to 20 times range that we were seeing most commonly in the 2021 to 2022 time period when rates were low and more leverage was available. Particularly technology deals, which we know drives 25% of the index, was much more prevalent 2 years ago than we're seeing today. We do believe that M&A transactions will pick up as many lenders are starting to see an uptick in their pipelines. It's simply just taking sponsors a little bit longer to adjust to the rate environment, which now folks believe is going to be higher for longer. To be determined if we have rate cuts this year. But earlier this year, folks were expecting more rate cuts than we're most likely getting. And in fact, PitchBook just recently reported that 30% of buyout assets are in funds, private equity funds that are 5 years and older. And so what that means is it's just a matter of time for M&A to return as sponsors have a deep desire to sell assets. But until that happens, the immediate result is of this slowdown in M&A and pickup in refis has been that the all-in yield to 3 years within the Cliffwater Direct Lending Index has started to tighten materially for 2 consecutive quarters. So you can see this in the chart on the right. We're in the high 11% area, down from the mid 12% area late last year, due to a lot of these repricings that are happening over the last 2 quarters. Moving to the next slide, this supply-demand mismatch is happening across the size spectrum within direct lending, both in the lower end of the middle market, the middle, and the upper end of the direct lending market. So looking to the chart on the left, we can see that spreads have been tightening across the universe to the point now that in the second quarter, lower, middle, upper has this very narrow 10 basis point band of spreads. They're basically on top of each other. In fact, some managers that were moving up market and that often play at the upper end are now starting to venture back down market in an effort to deploy and find better yields and hopefully more deal flow. Now, while managers are not earning the same level of spread premium that they're used to on these smaller transactions, the terms are obviously much better on smaller deals. They have covenants, they have tighter docs, they have lower leverage. So we are starting to see a lot more competition moving down to the lower end in the effort to find better risk-adjusted return. And because larger lenders are competing much more now with the BSL market. Now, despite this tightening of spreads that we're seeing within direct lending, the chart in the middle of the page here highlights that the pricing in the public loan market is actually tightening even quicker. So we all know direct lending typically earns anywhere from 100 to 200 basis points liquidity premium over the public markets at any point in time. Right now, we're still at the high end. We're at 200 basis points. So as much as everybody wants to say it's a race to the bottom, the yield premium is still intact. It's better than what we saw in 2021, 2022, although it does still feel like yield pressure is present and has not yet abated. Moving to the next slide, there's been a lot of discussion, a lot of articles out in the media about the BSL market taking back market share from the direct lending market that I wanted to address. While this is certainly a trend, it is to be expected given that all the financing markets are now wide open as opposed to being shut 2 years ago. And you do see financing markets wide open during periods of economic calm. So this is to be expected. But the direct lending market and the public loan and high yield bond markets can all coexist together. And the competition does not overlap as much as one would think. In fact, while there is a repricing wave running rampant in the BSL market, we haven't actually seen that many direct lending deals leaving direct lending to go BSL. We've seen different data providers put out estimates that maybe about 15 billion in direct lending loans have left direct lending to go back to the BSL market to reprice so far this year. That's only 10% of the repricing volume that's actually gotten done in the institutional loan market, because we know it's been over 215 billion. So 10% is really not that much. And if you think about the fact that direct lenders financed over 200 billion in mega uni M&A deals between 2021 and 2023, losing only about 15 billion to the BSL market is pretty minor. That's less than 10%. So the greater competition is in fact direct lenders competing with each other to win these deals. And when we assess the two executions, private equity sponsors mostly choose the BSL market, yes, to shave down price and obtain looser terms and docs. And so that market does often have a heavier share of refinancings, but they mostly do this on deals that really don't have a lot of tuck-in opportunities. Meanwhile, a sponsor chooses direct lending more often for M&A roll-up strategies. And so what the chart here on the left is showing you that is that the typical deal, if we look at the commitment on a typical deal in the market in the form of DDTL term loans, and we compare direct lending executions compared to BSL institutional executions, direct lenders offer a huge advantage in that they can offer these big DDTL term loans to sponsors. In fact, DDTLs make up anywhere from 15 to 20% of an individual deal's commitment amount. Meanwhile, the BSL market really doesn't love DDTLs. CLO vehicles really don't have a natural home for these facilities, and they often charge sponsors ticking fees, which can be expensive. And you can see this in the chart here that in normal market conditions, DDTLs only drive 5 to 10% of commitments in the public loan market. Direct lenders also offer PIK flexibility with interest rates, which is also a huge tool that they can use to win over the BSL market. And sponsors that are really interested in these bells and whistles, they're going to stay with direct lending executions more often than not. Meanwhile, on the right-hand side of the page, we can compare direct lending to the high-yield bond market. High-yield bonds are even less flexible for sponsors. Most often you see corporates that have high single B or low double B rating that want long-term corporate purpose type capital going to the high-yield bond market versus folks that are looking for prepayable debt. They want to finance roll-up strategies and asset-light businesses. They're going to go to the direct lending market for a much heavier amount of these deals. So the point here is that while all three financing markets are wide open and competition is everywhere and everyone's offering favorable terms, these three markets aren't fully competing with each other on all deals because PE sponsors choose different executions for different reasons. It's not just all about which one's offering the cheapest price. And then moving to the last slide, I want to just end the presentation addressing portfolio and borrower health within the direct lending universe and within the index. Steve showed earlier in the presentation that losses remain muted. The non-accrual rate and the default rate was very benign at 1Q24. It's still only at about 1.4%, which is well below the long-term average. This is a testament to how well the economy is performing. It's also helping that the direct lending universe is flush with capital, which is helping borrowers navigate liquidity issues as they arise every quarter, and that's keeping the default rate down. But the other two key barometers of health within direct lending that we can point to is the level of PIK interest embedded in the interest rate on the loans across the index, and where lenders are ranking their loans on their watch lists. So we do continue to see the level of PIK embedded within interest rates within direct lending slowly climbing. About 15% of first lien loans across the BDC landscape have some level of PIK component or flexibility built into the interest rate through 1Q24. Now, while outside observers will look at this stat and say, oh, stress is building within the space, I highlighted earlier that being able to offer PIK to a sponsor is also a tool to win mandates and to win agencies and to win share over the BSL market. And so it's not always a sign of liquidity pressure. In fact, when we calculate the level of PIK income flowing through investment income figures within our index, the PIK level is actually closer to 7% of income. And that stat has been roughly flat in the 7% range for over 7 quarters. We would see that build if there was liquidity pressure, and it's been pretty flat. Meanwhile, on the right-hand side of the slide, we can see the risk ratings within the CDLI index. The watch list, which is risk ratings 3 and 4, it's still flat at around 10% for the 4th consecutive quarter. So while borrowers are starting to show signs of slowing growth across the market, it's not to the point that it's causing widespread stress in the direct lending market, despite what all the headlines might be portraying. We are certainly seeing some sectors face more pressure than others, and rising base rates are causing dispersion in performance across managers' portfolios based on the type of risks that they decided to take on. But that's to be expected given where base rates are and how thin coverage ratio and interest coverage ratios are. It just does leave more margin for error. But again, those lenders that stay up in quality, they can build large diversified portfolios, they can avoid big concentrations, they can mitigate hold size levels, they're diversified across sectors. They're showing loss rates well below the 1% long-term average when we dig into the data. And so that concludes our prepared remarks. I'll turn the presentation back over to Steve to sign off.
Hey, thanks, Fran, and thanks everybody for joining us and for your support. We'll talk again in August when we will present the second quarter results. As we sit right now, we don't expect or anticipate much change in the general trends. Thanks, Fran. Thanks, everybody. See you in August.